Hello everyone, welcome to Chapter 2. In this chapter, I'm actually going to take you through some sample transactions with the sets of books and records. All right, and as we stated in Chapter 1, there are three primary financial statements, actually four. And as you see them here, the first one, as you see, it is called the balance sheet. Second one is called the income statement. The third one is a cash flow statement. There's also a fourth financial statement called a stockholders' equity statement, and we'll study that later in the course as well. So first, let me explain what the balance sheet is all about. The balance sheet is basically a snapshot of the organization at a specific point in time. Now, you all take photographs. You all know what a camera is. You know the reason why you take photographs. The reason why you take photographs is you want to capture an image at a specific point in time. And we all love to look at photographs years later after the photograph was originally taken. And that is a beautiful thing because we see, oh yes, I remember that particular situation years and years ago. Well, when you think of a photograph, think of a balance sheet. And that's exactly what the balance sheet does. It explains the financial position of an organization at a specific point in time. So that is what the balance sheet is all about. The balance sheet includes accounts such as the assets, the liabilities, and the equity accounts. In a few moments, I'm going to be expanding upon these three categories of accounts. But once again, number one, the assets. Number two, the liabilities. And number three, the equity accounts. All right, the second financial statement that we see listed here is the income statement. Now, the income statement is much different than the balance sheet. Like I said, the balance sheet was basically a snapshot. It was basically a financial position snapshot as of a certain point in time. An income statement, on the other hand, is for a period of time, and we see that wording here in red. The income statement summarizes all of the revenues and expenses from a begin date to an end date. And a lot of small companies, what they're going to do, actually all companies, they're going to create an income statement for a year at a time. Now, some companies might do it a month at a time or a quarter at a time, but everyone does it as an annual basis. So it's capturing the revenues, basically the money we've earned from providing a service or selling a good to a customer, less the expenses. The expenses are the charges that we actually need to spend to earn that revenue, and it captures it for a year period. And as you probably imagine, the statement of cash flows basically is, once again, it is for a period of time, just like an income statement. And it basically summarizes all of the inflows and outflows of cash. How did our cash balance go up? How did our cash balance go down for a period of time? It's kind of like summarizing your own bank balance. If you all have a bank balance, and if you take a look at your bank balance on January 1st of the year, and you look at your bank balance at December 31st, 365 days later, now it could be quite possible that that bank balance, 365 days apart, maybe the bank balance is relatively similar, but if you look at the detail in between, there were a lot of ups and downs probably. Right, all the bills that we pay, plus all the income we receive. So that's what the statement of cash flows is doing. It is summarizing all the ups and the downs for that period of time. And that's what we do with our financial statements. Now let's go through an example. The example is going to be Vagabond Travel Agency. And as we see here, you can see the title of this financial statement says Statement of Financial Position. This is just a fancy way of saying balance sheet. And remember, like what we said, a balance sheet is a summary, it's a snapshot, if you will, of the financial position as of a certain date and time. So at the close of business, December 31, 2015, this is what our position was. And on the left side of the balance sheet, we can see we have listed assets. Assets are basically what the company owns. What do we own? Cash, right? We have a bank account. And at this moment in time, we have $22,500 in our bank account. We have receivables. You see these words? Notes receivable, accounts receivable. These are monies that other individuals or other organizations owe us. They're basically IOUs. Right? And when people owe us money, they are assets. We're going to try to collect it. We're going to hire a collections team. And so certainly we own them. Supplies. This is basically the short term of the current supplies. The pens, the pencils, the paper, the staplers. And then we have other items here. You can see we've got office equipment, building, land. These are considered, in your text, you might see the term property, plant, and equipment. It's an overall category that includes what I'm going to call longer term assets. These are assets that are used in the business, but much longer than the supplies. The supplies are going to be used up pretty much currently, but these longer term assets may take multiple years for us to get full use out of them. So on one side of the balance sheet, we have our assets, and that totals $300,000. On the right side of our balance sheet, we have liabilities and owner's equity. The liabilities are the debts of the organization. These are the amounts that we owe to others. And you can see there's a common word here, payable. Notes payable, accounts payable, salaries payable, the $80,000. And then we have the equity. The equity represents the ownership claim of the business. The accounting equation here, if you haven't figured it out, is assets equals liabilities plus owner's equity. You could also restate that by saying assets minus liabilities equals owner's equity. So the owner's equity, I think a lot of students understand that a little better when they realize the owner's equity is the leftover. After liabilities are paid and the assets are liquidated, the equity is really the leftover. You can see the equity is broken up into two categories. You can see the first category, capital stock. This represents the owner's investment in the business. So when the owner actually invested their own money in the business, it comes here, capital stock. And the retained earnings, that represents when the company actually runs the day-to-day operations, when they earn money, when they earn revenue, less paying out expenses and dividends, which is a distribution to the owners. This is the accumulated amount that's left, that's been earned but has not yet been paid out to the owners. Okay, so these are the two equity accounts. So once again, balance sheet equation or the accounting equation, assets equals liability plus owner's equity. And what we're going to do is we're going to practice a few business transactions to see how we can build this financial statements. Okay. Before I go through that, this is a very important slide, and this is a big pet peeve of mine as well. Take a look at what this says. A business entity is separate from the personal affairs of its owner. Me, as a CPA, this bothers me to no end. I can't tell you how many clients I get, and they actually hand me a whole bunch of paperwork, and it's commingled personal and business credit cards, yet they have to explain to me sometimes they bought business, they incurred business expenses, but they use their personal credit card and vice versa, and it's a mess. People have to realize that they are two separate entities. If you own a company 100%, that company is separate in the eyes of the law as you. And you really have to separate the financial affairs of the two. If you are on company business, use a corporate credit card or debit card. If you are buying something for your personal nature, use your personal debit or credit card. Okay, as we said, the assets are basically what companies own. And you can see the formal definition here. They're the economic resources owned by the business. And they're expected to benefit future operations, of course. All right, couple of principles that we need to understand here. The first oval you see here says stable dollar assumption. Now I know there's a whole bunch of foreign countries out there where their currency is not stable. There's a lot of inflation or deflation. Luckily here in the United States, our currency, our monetary unit, the US dollar, is relatively stable. And that is an assumption that the dollar is going to remain stable. That's very important. The second one here, it says cost principle. All of our transactions are going to be reported at the cost that we paid for them, or the cost we are receiving. Objectivity, there's not going to be any subjectivity in our recording of financial transactions. It's going to be verifiable with supporting documentation. It's objective. And the last oval says going concern assumption. What that means is we are under the assumption that the business has the ability to continue in the future. If it doesn't have the ability to continue in the future, that needs to be known when we put this financial statement together. Okay. Liabilities, now we're on the right side of the balance sheet. The liabilities are the debts of the organization. And debts represent negative future cash flows. And then the leftover is the equity. Equity represents the owner's claims on the net assets of the business. And like I said, the assets less the liabilities. That's the equity. It's the leftover. All right, here's the accounting equation once again. And I usually say this about in this type of class. If there's one thing you remember from this class 20 years from now, it's this. This is the most important thing that you will understand in this class. The accounting equation. Assets equals liabilities plus owner's equity. Assets equals liabilities plus owner's equity. Write this down, put it on a piece of paper, tape it to your wall, do whatever you have to do to remember this. If you can at least remember this 10, 20 years from now, you will have an understanding, you will have some sort of idea of all of these financial documents and the order it should go in. Okay, because if you can understand this ordering, this equation, you are a step in the right direction. Instead of handing your accountant the shoebox full of papers and receipts and whatnot, if you can put it in this order, the accountant is going to love you. All right, now let's take a look at a brand new company, Overnight Auto Service. This is a brand new company. It's just being started on January 20th. So on January 20th, we have an individual, Michael McBrien. He's going to start this overnight auto service. So he and his family, they decided to invest $80,000 of their own personal money in the business. In exchange, they received 8,000 shares of stock at $10 per share. Basically, what the stock represents is ownership units in the organization. And what we're going to do here is we're going to build our balance sheet. And remember the formula. Assets equals liabilities plus owner's equity. Well, every business transaction, let me say that before we go through the transaction itself. Every business transaction has at a minimum 2 accounts that it affects. In this scenario, in this business transaction, the cash account has increased, right? The organization, the company received $80,000. So my cash account is going to increase $80,000. In exchange, the company gave out ownership shares to this new owner, Michael McBrien. So the capital stock account, which is under the equity category, is going to increase. So does my accounting equation equal? And you can see me going back and forth here. Yes, it does. All right, so that is typical of the first transaction in the history of a business. The new owner puts in some of his own personal money to get the business going. Now what happens? The next day, January 21st, overnight purchases land from the city. So now we got to find some land and so we can build our garage. And they decided to buy from the city a piece of land. It cost $52,000. And so what's going to happen is as follows. Take a look at the two assets now. One of the assets, cash. Remember it had an $80,000 balance? It went down. It went down $52,000, and now the running balance is $28,000. 80 minus 52 is 28. But now we have this new asset called land, $52,000. So with that business transaction, one asset increased, the land, and one asset decreased, the cash. Does my accounting equation still work? Absolutely. My assets still equal my liabilities and my equity. Now the next day, January 22nd, overnight purchases an old garage for $36,000. Well, how was that paid for? We purchased the garage for $36,000, and so that's this new asset here called building, $36,000. Well, how did we pay for it? Well, what we did is overnight paid a $6,000 down payment in cash and was issued a 90-day note payable for the remaining $30,000 owned. This is pretty interesting. Do you remember on the prior slide the cash balance was $28,000? Now look at it. It's down to $22,000 because we wrote a check for $6,000. And we've entered into a new liability, a new debt, and that's over here, the note payable. It's $30,000. And you can take a look. My accounting equation still works. We have assets of $110,000 and we have liabilities of $110,000. The next day, January 23rd, overnight purchase tools and automotive repair equipment for $13,800 on account, due within 60 days. Now there's one thing I want to point out to you. Whenever you see this term on account, that means cash did not change hands just yet. So that means we bought the equipment, but we didn't pay for it yet. So the $13,800 is a brand new asset, and we're going to put that over here on the asset side, tools and equipment, and you see the balance, $13,800. But over here on the liability side, we have a new debt, and we'll call that accounts payable, $13,800. And once again, after every transaction, our balance sheet balances. All right, now the next day we realized, you know what? We bought too much. We bought too much tools and equipment. So the next day on January 24th, overnight sold some of the new tools to a company called Ace Towing for $1,800, which is the same price that we originally bought it at. And Ace agrees to pay the amount within 45 days. So we sold equipment which cost $1,800, but we didn't get paid for it yet. So the tools and equipment, remember it had a $13,800 balance? Now we're down to $12,000. This account got reduced by $1,800. And we didn't get paid cash yet, but we have this new asset called accounts receivable. Right, this is an asset. We are going to try to collect that from Ace. But we own the rights to receive that $1,800. So one asset went up, the accounts receivable went up, and one asset went down, the tools and equipment. All right, a couple days later, Ace Towing paid. You remember the company literally that just entered into this $1,800 receivable? If I wanted to back up there, they're paying off some of it. So they decided out of the $1,800, that Ace owed us, $600 was paid. So the accounts receivable, which was once $1,800, it's now down to $1,200. And the cash, which was sitting at $22,000, has now increased to $22,600. So one asset went up, cash, one asset went down, accounts receivable. All the while, our balance sheet is still balancing. All right, the next day, Overnight made a partial payment. Remember, we owed some money when we bought the tools and equipment. I think we owed, yes, we did. We owed $13,800. We decided to make a $6,800 payment. So the accounts payable, which was once $13,800, it's gone down $6,800. And our cash balance also went down $6,800. So we're paying off some of that liability, but the accounting equation still works. 4 days later, finally, after being open for 11 days, Overnight basically serviced their first customer. Overnight recorded auto repair services provided in the last week of January for $2,200 received in cash. So what's happening is we've earned our money. When we earn money, we're going to increase this retained earnings account. And remember, this retained earnings account there's really subcategories, and I'm going to explain this in a little bit. But the retained earnings account includes 3 subcategories. Number 1, revenue, which was going to make the retained earnings increase. Number 2, expenses, which is going to make the retained earnings decrease. And number 3, dividends, which will also make the retained earnings decrease. If you think of the first letters in those 3 words, revenues, expenses, dividends, we have an R for revenue, an E for an expense, and a D for dividend. R-E-D. You're going to hear me talk about the red accounts a lot, and these are the red accounts. So the revenue makes the retained earnings increase. And of course the cash was increased. Same day, January 31st, Overnight paid general operating expenses of $1,400 in cash. So we're going to see our cash balance is going to be reduced by $1,400. And the retained earnings, because we're recording an expense, it's going to be reduced by $1,400. It was $2,200, now it's down to $800. Okay, this slide is a summary of everything we just went through. Now you're looking at this saying, oh my goodness, I can't believe I did that. Yes, you did. We went through all of these transactions from the beginning of the organization on January 20th all the way through to January 31st. And what we're going to see is every account, we captured the increases and the decreases, and at the end of the month, we're going to take a snapshot. Remember, the photograph, and we're going to keep these running balances to create the balance sheet. So we have our cash balance at the end of the month, $16,600. Accounts receivable, $1,200. Tools and equipment, $12,000. Building, $36,000. Land, $52,000. That's one side of the balance sheet. The other side is the liabilities and the equity. We have $30,000 in note payable. We have $7,000 in accounts payable. And our 2 equity accounts, the capital stock is $80,000. And at this moment in time, our retained earnings is $800. Now, that's the balance sheets. There are 2 other financial statements. The second one is the income statement. The income statement is simply the revenues minus the expenses. That's why these 2 items here in the retained earnings column is circled. And then we have our cash flow statement, and you can see the entire cash activity in the cash is in a rectangular box. This information we're going to use to prepare the statement of cash flows. Okay, as I just said. Okay, now here is the income statement. And like I said, the income statement, it is not a snapshot like the balance sheet, but it is for a period of time. It's got a begin date and it's got an ending date. Because this is a brand new company that was incorporated on January 20th, we can see that the income statement is for the period January 20th to the 31st. The income statement is simply a summary of the revenues minus the expenses. And as we saw on the prior slides, the revenue that was generated for the period was a total of $2,200, and the expenses were a total of $1,400. They are broken down: wages of $1,200 and utilities of $200. They add up to $1,400. All right, let me explain a couple of things here. Whenever you are preparing a financial statement, it starts with 3 rows. Okay, the first row is the name of the company, in this case, Overnight Auto Service. The second row is for the name of the financial statement, in this case, income statement. And the third row is for the time period. The income statement is for a period of time, so we're going to say for the period, the begin to the end, the 20th to the 31st. Okay, so revenues minus expenses equals what's known as net income. If the expenses happen to be greater than the revenues, that would be called net loss. We hope it never comes down to that, but it does happen from time to time. And when an accountant is done with his calculation, he or she's going to put a double underscore. Okay, this double underscore underneath the 1400, this is actually a typo. This should be a single line. And quite honestly, the single line above the 1400 shouldn't even be here. So you understand how that works. And here is the cash flow statement. And I'm not going to go through the details of the cash flow statement right now. This is something we're actually going to study later on in the course. Quite honestly, the last chapter in the course. And the cash flow statement, all it does is it summarizes how did we get from the beginning cash to the ending cash. And if you go back a few slides to the balance sheet, you will see that the cash balance at the end of January 31 is the $16,600. And cash at the beginning of January 20th was 0 because it was a brand new company. And here this details out how we get from 0 to 16,600. Okay. The cash flow statement will be broken up into 3 categories. We have operating activities, we have investing activities, and we also have financing activities. Once again, we're going to save the details for later on in the course. Okay, and then of course we have, as I said earlier, our running balances and all of our accounts in the accounting equation. They're going to be used to prepare the balance sheet. And as you can see here, those are the running balances in a nice, neat format. And just like the other financial statements, the balance sheet has 3 rows. The first line is the name of the company. The second line is the name of the statement, which is the balance sheet. And the third line is the date. Once again, the balance sheet is not for a period of time. It doesn't have a begin date and an end date. It's simply a snapshot. It's the photograph financial statement as of January 31. And we can see the listing of our running balances. Our asset accounts are here. And then on the one side, assets total $117,800 equals the liabilities and the equity combined. And you can see that's $117,800 as well. All right, balance sheet balances. Okay, and as I said, I've been saying this all along, the balance sheet is a snapshot statement. You can take a balance sheet at the beginning of the period, you can prepare a balance sheet at the end of the period, but everything that happens in between, that would be for the period's ending. So that would be the income statement and the cash flow statement. It's for a period of time. It's not a snapshot statement. This next slide is really good because what this next slide does, it shows you that all of these financial statements that we put together, they are connected. You can see the income statement. What did we have? We had the revenues minus the expenses gives you net income. Well, the net income is actually ultimately going to increase or decrease the retained earnings directly. Since this is a brand new company, the net income equals the retained earnings statement. Now, in future periods, it won't be that. The net income will actually be the increase to the retained earnings from the beginning of the period to the end of the period. But we're going to study that in more depth as the time goes by, the chapters go by. And of course, on the asset side, our cash account, $16,600. The cash flow statement is detailing out how we got to that $16,600 from the beginning period, in this case of 0. Okay, so you can see the correlation, the connection between the financial statements. Okay, financial statements are really good. It shows the financial picture of the organization. But this slide is basically saying there's a lot of non-financial information that is really, really important as well. So that is important. Management's interpretation of the financial statements is important. Industry standards. Compare our financial information to industry standards, your competitors. What economy are we working in? All of these are very important factors in analyzing a business. What I'm trying to say is it goes beyond just the financial statements, but this is such a critical part in understanding the health of the business. Businesses can be organized in many ways. We are going to concentrate in this class on corporations. A corporation, as you see in the right-hand part of your screen, this is when a bunch of owners invest their own money in the business and they become shareholders. And the shareholders will ultimately get rewarded through the payment of dividends or appreciated stock. All right. There are other forms of business. We've got sole proprietorships and we have partnerships. A sole proprietorship is usually when there's one owner. All right, and then a partnership is when a few individuals get together and they run an organization. But like I said, we're going to concentrate on corporations in this class. This is how the equity section would look like in the 3 forms of business. In a corporation, we've got capital stock and retained earnings, and this is fairly similar to what we've seen so far in our studies in this chapter. If it was a partnership, each partner would have their own capital account. And if it was a sole proprietorship, the one owner would have the one capital account. Okay, so once again, we're going to study and concentrate on corporate form of business for accounting. Okay, now, external parties like a bank or potential investors, they're interested in making sure that the company is liquid and it's profitable. What do we mean by that? Liquid. That means there's an ability to convert everything to cash. If we have a lot of receivables that we have trouble collecting, or we have a lot of fixed assets, what I mean by fixed assets, the property, the plant, the equipment, the land, and it's not easily sellable, that's a liquidity problem. Some of you may have experienced that in your lives, or you have seen that in your own organizations, where you have a healthy balance sheet. You've got a lot of assets, but it's not so liquid. It's very hard to get to the cash. Liquidity is a big deal. And profitability. Remember what we saw in the income statement. Revenue minus expenses equals net income. That's what profitability means, that net income number. Is it a healthy number? Is it too small? Is it big? Now, not only do we prepare the financial statements, we also prepare footnotes to the financial statements. And the footnotes are basically writing of sentences that explains, it discloses certain aspects of the business and might explain in a little bit more detail some of the numbers you see on the financial statements. So footnotes is actually part of the overall financial statements. All right, creditors, obviously, they're going to look to make sure that a company is profitable and they're liquid. That is important to them. We want to make sure that we get these financial statements in the proper orders for our banks, and to lend us money and continue to lend us money. That's an important part of running the organization. Thanks for sticking with me with Chapter 2.